You're watching episode 30 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. I'm Brandon Hall, and before we get started, I invite you to join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Additionally, if you have any questions or if anything that I say resonates with you, please leave us a comment. I really enjoy engaging with the community. The folks that take 10 to 30 seconds out of their day to drop me a line, you guys are my oxygen. You keep bringing me back to the table to create more of these videos. So thank you so much for doing that. And lastly, click that subscribe button. Once you subscribe, click the bell icon to make sure that you get notifications of future videos that we drop. We drop a daily video. We also have podcasts, live Q&As, and webinars. And I don't want you to miss any of those. Today's topic is going to be closing costs explained. So I'm actually going to share my screen and we're going to walk through a closing disclosure together. I'm going to go line by line and kind of show you what I look at as I'm an accountant for landlords, for real estate investors, and hopefully you'll gain some insights so that you can look at closing disclosures as well, because let's be honest, they are a little confusing, especially if this is your first 1, 2, or 3 properties that you're picking up. And the closing disclosure forms actually changed. I believe it was 2017 or 2018. So before that, it was a different format, and they changed it to this format to try to make it a little bit more clear for investors or for anybody purchasing real estate. All right, so this is a closing disclosure. The property was purchased on February 19th, 2021. So this is a relatively recent one. We've got the sales price right here, so that's important to see. Now, ironically, I actually like to skip this first page and the second page. I like to go straight to the third page because this is where you kind of get the summary, and then I go back up the couple pages to kind of get some more detail. So the first thing that I like to look at is I start on page 3. And I look at the summary of transactions. Now, on the left-hand side here, we've got the borrower transactions. On the right-hand side, we've got the seller transaction. So the borrower and the seller will have all of their costs and everything detailed here. And then at the end, we've got cash to close from buyer and cash to seller on acquisition or on liquidation here. So at the top of the borrower transaction, we have due from borrower at closing, $258,000. Now, this is a sum of these two numbers. So we've got the sales price of the property plus the closing costs due from the borrower at closing. So those are the closing costs that are incurred here. And that you see this like reference J. J is going to be up a little bit. So we're going to go take a look at J, section J here in a second. And we're going to get a detail of what that $8,150 amount is. So total costs from borrower is going to be $258, or total cost to borrower is going to be $258. But then you've got a summation of costs that have already been paid either by the borrower or on behalf of the borrower. So you've got the deposit, which is going to be like escrow, or this is a North Carolina transaction. North Carolina, we have due diligence. So we'd have due diligence and escrow to make up a total deposit of $5,500. We also have a loan amount of $187,500, and then we've got a seller credit. The seller credit's obviously negotiable. And then down here, we've got county property taxes. And sometimes you'll have city and some other assessment taxes as well. But all of these numbers make up this sum right here. And what we're trying to do is we're trying to figure out what is our total cash from borrower at closing. So when I'm at the closing table, what number do I need to put on the check to close? And it's $61,844, and we get that by subtracting the $258 and the $196 number. The $258 number is right here. The $196 number is right here. Now, sometimes people get confused with this, like paid on behalf of or already paid by the buyer. But you got to remember, like if I'm buying something for $250 and I put $5,500 of escrow in, then I'm not going to go and pay $250 at closing. I would pay $250 minus $5,500. If I'm getting a loan, I'm not going to pay $250 at closing. I'm going to pay $250 minus the loan amount. That's the down payment, right? If I get a seller credit, then I'm not going to pay $250 at closing. I'm going to pay $250 minus the seller credit. And if we've got a tax adjustment, I'm not going to pay that tax adjustment at closing. I'm going to pay $250 minus the tax adjustment. So these are all minus transactions. We're going to subtract all of these amounts because they're paid either by me or on behalf of me by some other party. And this is a good transaction because we've got a seller credit and we've got this property adjustment. I'll talk about seller credits here in a second, but let's talk about this property tax adjustment. So in North Carolina, you pay your property taxes once a year. And the seller had not already paid property taxes in 2021. So you see that there's a proration here. total, what you do is you look at the total property taxes for the year, and then you prorate it for the use that the seller had during the year. The seller's got to fork out property taxes for their use of 1.5 months of this property for the year, right? Like you don't want to go buy the property and have to also pay property taxes that have accrued from January 1st through the selling date, because you didn't use the property for that amount of time. So what they do is they run a calculation to figure out how much of what is that accrual amount of the use that the seller had, but the seller hasn't paid in property taxes, and they give the buyer that adjustment. So the buyer in this example actually got to reduce their cash out of pocket by $306, because that $306 is the prorated amount of property taxes for the use of the property between January and the closing date by the seller. So the seller is effectively paying this. All right, let's go up to calculating the cash to close. So we've got total closing costs. This is the estimate column. So this is, your lenders have to provide you with a loan estimate. That's what this is. This is the estimate column. So they estimated $8,800 of closing costs, a down payment of $6,200, a deposit of $5,500, and cash to close of $65,000. Now the final ended up being $8,100 in closing costs, a down payment of $62,500, a deposit of $55,000. We got seller credits, and then we also have an adjustment here. So because of the seller credits and the adjustment, and because the actual closing costs were a little bit lower, we only need $61,844 cash to close. Now that $61,844 should match this number down here. So that does match, and that is good. Now I also like to see the seller transactions over here on the right-hand side, because I like to know, as an accountant, but also when I'm purchasing rental property, what sellers pay, just to keep tabs on everything. And so you can see the seller credit here. It actually reduces the amount that they're going to get out of this $250, right? So their calculation's a little bit different. You can see here's the amount that they should be getting. Over here, it's the amount that we're paying, but the seller it's the amount that we're getting. So we're getting $250, and we're subtracting out what we're getting by the $3,000 of seller credit that we're going to give to the buyer, which shows up over here. We're also going to be subtracting out the closing costs to the seller. And again, we're going to reference column J, or section J, to see what that $13,125 amount is. So the cash to the seller in this example is going to be the $250 minus the closing costs, whereas the cash from the buyer is going to be the $250 minus the amounts paid on behalf of the borrower at closing. All right, so let's go take a look at J. What is section J? So here we go. So this is all, so section J is your total closing costs. That's really where this is all being referenced. But we want to see a closing cost detail, right? So of my $8,000 here, how does that break down? Well, we've got $5,000 of lending costs, and we have $2,900 of other costs. So let's see how that $8,000 amount breaks down. So first, we've got of the $5,000 of lending costs, we have $2,800 of origination charges. Now, what are origination charges? Origination charges are like pure profit to the bank. They're typically negotiable. In this example, they paid $2,800 of origination costs. I would probably try to negotiate that. So we've got a commitment fee, which is just another profit center for the banks. And we also have a 0.875% of loan amounts. These are points paid. So the commitment fee is typically the bank pure profit to underwrite the loan. Sometimes you'll see it as literally listed as an origination cost. And then we've got points paid. Now what points are is basically paying upfront interest to reduce your actual interest rate. Now, if we scroll up here a little bit more, we see that the interest rate on this loan is 3.375. So the borrower had to pay some percentage or some amount to reduce the interest rate to that 3.375% on the loan. And the cost to reduce the interest rate to that percent was $1,640. So you essentially are going to pay an upfront fee to reduce the interest rate long-term on a loan. So the interest rate that was originally quoted to the buyer was not 3.375. It might have been like 3.5 or even higher than that. But the buyer decided, I want a 3.375% rate over the lifetime of this hold, and I'm willing to pay a little bit up front to drop my interest rate to that amount. Now, why would you do that? Well, the cool thing about paying points up front is that you can literally put it into a spreadsheet and you can see exactly how long it's going to take to pay off. So if I make an upfront payment of interest today, I can see how long it's going to take for the interest savings on the loan to pay off. Typically, the break even is about 4, 5, or 6 years. So the question becomes, if I'm going to hold it longer than that break even point, then it makes sense to pay down some interest today up front, make that upfront payment to get the lower rate over the lifetime of the loan. If you're planning to hold property and not refinance for a period of 10, 15, 20, 30 years, then typically prepaying points is going to make sense. But again, you can do this calculation in Excel. Maybe I'll do another video on that at some point, but it is a relatively easy thing to see, and it just gives you, the buyer, more confidence in making these decisions. This buyer decided, I'm going to pay $1,600 up front to write my interest down, or to get a lower interest over the lifetime of the loan on this. And I'm not going to go and do the break-even calculation right now to see if that was a good decision. The commitment fee is that origination fee. That's pure profit for the bank. It's for their services of underwriting the loan, pulling everything together. That is typically negotiable. But those two fees are making up $2,800. Now, services that the borrower did not shop for. So that's going to be your appraisal fee. It's going to be the credit report, a flood certification, tax service. These are typically like doc stamps, anything like that. So actually, those might not be doc stamps; those might be down here. But these are services that you did not shop for. These are services that you did shop for. Now, what does shopping for mean? Just means that you, the lender offered this one option, and you said, "Yeah, I'm going to shop around for this." You might go with that option, or you might choose a different option. So typically, your settlement location, your title insurance, those are going to be services that you do shop for. These are going to be services that you don't shop for. So our appraisal costs $775. Now, the appraisal, you don't put a property under contract and then pay out of pocket for an appraisal. Typically, it gets rolled into closing. So it's just part of my closing costs. It's part of the $8,000 right here. And remember, that $8,000 actually increased the total amount of the cost to the buyer, right? So I'm going to pay for that appraisal at some point. It's just going to be at closing with my cash to close. All right, so going back up here, so our credit report was $61, flood cert was $50, tax service was $80. Credit report here looks like this was a married couple. That's two credit reports, I believe. All right, services that the borrower did shop for. We've got title insurance. You got to get title insurance on your property. It's so important. With the blockchain, that might change. Actually, it might be a little bit easier and less costly to get title insurance going forward. This is our closing fee, our settlement fee that the borrower paid the attorney's office to eventually close. So these costs are all considered loan costs. All of these costs are associated with getting the loan, because if you didn't have to get a loan, you wouldn't have to incur any of these costs. Now, would you want to get an appraisal? Yeah, you would probably still want to get an appraisal. Would you want to get title insurance? Yeah, you would probably still want to get title insurance. But all of these costs, and you would probably still have to pay, obviously, that settlement fee, but all of these costs are considered loan costs. If you don't get a loan, a lot of these go away. So the total loan cost was $5,200. Now let's go look at the other costs. We've got recording fees. These are costs that the government charges to record the sale in their system. We've got prepaids. So prepaids are important to understand, especially for tax purposes, because we see a lot of accountants make mistakes with this. And I'll talk about the mistakes here in a second, but let's just go through some of the prepaids. So we've got prepaids. You're going to prepay your insurance for 12 months. How do you know it's 12 months? Because it says it's 12 months. So $775, you're cutting that check to the insurance company at the beginning of the year. You're also going to prepay interest. Why are you going to prepay interest? Well, you have daily interest from the time that you bought the property to the end of that month. And that's what they're doing here. So $17.34 per day for 11 days. I think that might be 11 days. It might be I don't know. I'm not that might actually be 10 days, because February ends on the 28th. But anyway, and it is 10 days, because 17.34 times 10 equals 173.4. There you go, folks. That's the extent of my math today. So prepaid interest, 10 days, you're going to get charged daily interest. So really important to understand that like even though you might not have to make your first payment for 2 months, you're still accruing interest on this loan every single day, every day since the day of closing, and they're going to account for that on at the closing table. You also are going to pay into escrow. So this is another mistake that people make. Again, I'll talk about that here in a second, but you're going to pay into escrow. So not only am I paying 12 months of insurance today, I'm also paying an additional 3 months of insurance into escrow. I'm also paying property taxes into escrow. So I'm going to pay the full 8 months of property taxes into escrow. We're going to escrow that immediately at this point. And then we've got an aggregate adjustment. I'm not actually sure what that was for. That might have been some sort of agreement that the borrower made with their lender. I'm not really sure what that's for. Okay, now we've got an other, and I'll talk about mistakes here in a second, but this stuff is where we see a lot of mistakes. So we'll come back to that in a second. All right, so now we've got other costs too, making up $698. We've got the survey fees. They paid for a survey of $500. We also have owner title insurance of $148. This is additional insurance that the owner received rather than the lender receiving. So the lender title insurance is up here, and then we've got owner title insurance right here. Now on the right-hand side, we've got the seller paid, right? So this was borrower paid closing. Everything that we just talked about, the left-hand column was borrower paid closing. But on the right-hand side, we have seller paid closing. You'll notice all of their columns are, all of their rows are blank because they're not getting a loan and they don't have closing costs other than these two closing costs. And these are real estate commissions paid to the seller, the seller rep, and then the buyer rep. And I'm not sure which one's which, but these were paid out, and so you can see the real estate commissions. Typically, sellers, at least in this market, definitely in this market, and in prior markets too, sellers are going to pay both the borrower, the buyer, and the seller commissions. But sometimes that can be negotiated in different types of markets. And then you've got a lender credit of $50. There you cool. Okay, big $50 lender credit. Okay, so you can see here you've got 8,200. You also have 13,125. So this is the borrower side. This is the seller side. Those are the two closing costs, and those should, sorry, the 8,200 minus the 50 nets out to that, and those should match the. Sorry, my software's kind of like, there we go. Those should match the seller cost reported here, and they do. So that's kind of that's kind of how you walk through. I always start at the summaries of transactions, then I walk through the actual detail here. If you want to see your loan, you can see it up here. You can see here's what the monthly interest is going to be, or the monthly payment's going to be. Here's what the escrow is going to be every month. We escrow insurance and property taxes every month unless you opt out of it. But the total monthly payment there is going to be $1,080 every single month. So, and this shows you property taxes and homeowners insurance are included in this $251 a month. So even though the loan is actually only coming in at $828, we're escrowing an additional $251 to get to the total monthly mortgage payment, or the total monthly payment of $1,080. Now let's talk about some mistakes that we've seen tax preparers make. And this can be really important for you as a landlord to understand, because you have to double check this stuff. So if this is a rental property, and this was a rental property, so if this is a rental property, we have to figure out what we're going to report as our depreciable basis, what we're going to report as land, and what we're going to report as our loan costs. So all of those are going to go on to all of those are going to go onto our balance sheet. On our 1040, it's a supplemental statement, it's a depreciation schedule, fixed asset schedule. And that's going to ultimately determine how much depreciation and amortization we claim on Schedule E every single year. Now, I'm not going to go through all of this today. I'm going to show you the mistakes today, but I'm going to have a how-to video probably in the next couple of weeks that's going to walk you through a calculator that we've built at our firm, so that we can run through this analysis very quickly. And I'm going to show you how you can get that calculator, how you can get access to that calculator as well, but that's going to come out in a couple of weeks here. It's going to be more of a tutorial. So when we purchase a home, first mistake that we see is that tax preparers will report the entire $250,000 purchase price as the basis that can be depreciated over 27 and a half years. And that is incorrect. That's incorrect for a number of reasons. First, it doesn't account for any of your closing costs. So you lose thousands of dollars in closing costs if all you're doing is reporting your purchase price as your depreciable basis. You always got to add to the depreciable basis the closing costs that are supposed to be depreciated or amortized. And we'll talk about that in a second. The other reason that this is wrong is that you're not accounting for land. You always have to account for land. Land cannot be depreciated. So you got to go 250,000 bucks times whatever ratio the property tax assessor says the land amount is worth. This is a property in Raleigh, North Carolina. I live in Raleigh, North Carolina. I know that the land ratio is about 15%. So 25 to probably $45,000 is what you're going to be looking at if you're in Raleigh, North Carolina. You're buying rental property. In this case, on a $250,000 purchase, you're going to be seeing about $25 to $45,000 of value being allocated to land. If it's $25,000, then that means that I can only depreciate $225,000 plus my closing costs. I can't depreciate the full $250,000. So I've always got to strip the land value out. So that's the first mistake that we see. The second mistake that we see is not accounting for closing costs correctly, not being able, not deducting from my depreciable basis any closing costs or any credits that I'm receiving. So let's say that my land value in this example is 10% of the purchase price. So my building is worth $225, my land is worth $25. But I then have to go and subtract out, and that just disappeared. Okay. I then have to go and subtract out the $3,000. So now I do $225 minus $3,000 because that's a benefit that I'm receiving. So I can't go and depreciate $225 because my actual basis in the property did not cost $225. It was $225 minus the $3,000 seller credit. I then have to go and add my closing costs, but I can't add all of the closing costs. I can only add the closing costs that are supposed to be added to the building basis. So how do I figure that out? Well, I come up here. I come back to that closing cost detail worksheet. My loan costs are not added to the building basis. I do not depreciate my loan costs. What I do instead is I take this total number, $5,229. I come up here and I look at how many years are we talking? We're talking 30 years. And I'm gonna take that 225, sorry, that 5,229 number. I'm gonna divide it by 30 years. I'm gonna put that on the balance sheet as a separate line item. So on your balance sheet, you should see building, land, and loan costs. And loan costs are gonna say 5,229 over 30 years amortization. And every single year, I'm gonna get 5,229 divided by 30. I'm gonna take that amount every single year until I dispose of this loan or I dispose of this property or the loan runs its course. So really important that you don't depreciate that. You should be amortizing the 5,229. Now, what do I add to my depreciation basis? Well, I'm going to add other. So I'm going to add the 698 here, and I'm going to add recording fees. I'm not going to add my prepaids. I'm also not going to add my escrow. This is where people make a lot of mistakes. So we have seen tax preparers just take this number and add that to their 225. So they would say 225 building, 25 land. Then they would subtract out seller costs. So now we're at 222 building, but then we would add 2,971 back. So now we're at 224 building, 224,900 building, and that is incorrect. In this case, you're only going to add back your survey fee and your title, and you're going to add back your recording fees. The 948 is prepaids. That's actually going to come out on Schedule E. So on Schedule E, I should see 775 because that's a current expense. It's an operating expense. It's not something that's capitalized to the building and depreciated over 27 and a half years. These costs are depreciated over 27 and a half years, but my homeowner's insurance only benefits me for the next 12 months. So even though I'm closing on the property today and I paid for it at closing, I'm still going to deduct the 775 on Schedule E. I'm not going to add it to Form 4562, depreciated over 27 and a half years. We have seen tax preparers add this to the depreciation basis and depreciate it over 27 and a half years. And that's a big bummer because you're spreading $775 out over a long period of time. We've also seen tax preparers, some relatively well-known tax preparers have added the insurance to the basis and also deducted it on Schedule E. So they'll take this entire number, they'll add it to that 225 building amount, and they'll also take 775 on Schedule E, and that's double dipping, and that's going to be a huge issue. Well, you know, it's $775, probably not a huge issue, but on larger insurance amounts, that can be a huge issue under audit. And obviously, it doesn't look good for you, doesn't look good for your tax preparer. So you can double check your tax preparer by making sure that they're not taking this entire amount and adding it to the building basis, and that they're making sure that these are on Schedule E. Prepaid interest, also operating costs, should be on Schedule E. Typically, this one's less of an issue, though, because your mortgage company is going to send you a Form 1098 at the end of the year. And we're just going to take that Form 1098, whatever that interest amount, plug it right into the Schedule E, and that prepaid interest is included in that amount. So typically not an issue there. But homeowners insurance, always an issue. I think accountants, investors definitely struggle going through this stuff, but accountants do too. So I hope that this video kind of helps you understand how to go through it so that you can hold your own tax preparer accountable to good reporting. Escrow payments are not deductible at all. You do not add them to the basis of your property and depreciate them. You also do not deduct them. You are paying them into escrow. Think of it as a bank account that you own, but you can't access. So just because you move something into like your Fidelity stock account doesn't mean that you get to deduct the amount that you just moved into the Fidelity stock account. You only get to deduct the amounts when the escrow actually releases the payment. So even though we're accruing 8 months of property taxes up front, and even though every single month we're going to pay more for those property taxes, you cannot deduct this every single month. You cannot deduct the upfront payment into escrow. You can only deduct when escrow releases these amounts for payment on an annual basis. Now, this makes sense because even though I'm prepaying 3 months of homeowners insurance, and even though I'm paying on a monthly basis the homeowners insurance escrowed amount, I already paid, oh, sorry, that's the appraisal. I already paid homeowners insurance up front, 12 months. That's the amount that's deductible. And then next year, this time, I'm going to pay it again. Escrow is going to release another $775 to get the next 12 months of insurance. So I can't go and start deducting whatever I put into escrow up front, nor can I deduct what I put into escrow on a monthly basis. So many people do this. They will deduct the escrow payments they look at their 1,080, they deduct the entire thing, which is also incorrect because you can't deduct principal. You can only deduct interest, but they'll deduct the 251 as well, and you can't deduct the 251. That's just paying it into a bank account that you technically have, well, I guess you technically don't, but think of it as paying into a bank account that you also own. You just can't access. So whenever that bank account releases payment, that's when you can go and deduct the amount on your taxes, and you would deduct it on Schedule E. So the only amounts here that we're going to add to depreciation are the $90,000 and the $698. We would add that to however we calculate here. So we've got 250 minus the cost of land minus our seller credit plus not 8,150 plus 698 plus 90. That's the amount that we're going to depreciate. The $5,000 here, those are loan costs. We'll amortize those over 30 years. Now, you might have said, wait a second, you forgot about the 306. I didn't forget about the 306. This is just a little bit more complex. So the 306 here, you don't depreciate, you don't throw it into your basis, you don't depreciate it. You actually make an adjustment on Schedule E. Sometimes it's a positive adjustment, sometimes it's a negative adjustment. In this case, it would be a negative adjustment because I'm getting the benefit. My cost is reduced because I didn't pay, or I shouldn't be paying for the use from January to closing. So my property tax expense on Schedule E will be whatever the property tax is for the year, whatever it ends up being, whatever that payment out of escrow ends up being, minus 306, because the payment out of escrow is going to pay all 12 months. Typically, you got to make sure that actually happens, that they actually pay all 12 months, but they're going to pay all 12 months out of escrow, but I didn't actually use it all 12 months, and I got a benefit for not using it all 12 months. So I would reduce my Schedule E expense by whatever that annual property tax bill is actually going to show up as. So I hope that that makes sense. I hope that this was a helpful video. In the future, I will show you how we walk through it at the firm, and how we do it for clients. I'll show you the calculator that we use, and I'll also show you how to get access to that calculator, because I think that it'll really help you hold your tax preparers accountable. It can be really tough to see this stuff on your tax forms. You do have to go and look at the depreciation detail listing. It's a supplemental statement to the tax form itself. Some tax preparers don't include it. They don't like to give everybody their information, or the calculations, but you should be requesting it. You should be looking at it every time that you acquire property to make sure that the closing costs are appropriately accounted for, and to make sure that your Schedule E makes sense. You want to make sure that your operating costs are appropriately accounted for. And I just showed you that there are some operating costs baked into these closing disclosures, like your daily interest, like your homeowner's insurance, that may or may not be picked up, may be double counted. Ultimately, it's on you as the tax preparer to make sure that information is correct. So we'll keep walking through some of this stuff to hopefully make it easier on you to review it and hold your tax preparers accountable to high quality returns going forward. I hope you enjoyed today's Tax Smart Daily video. Thanks so much for watching. If you have any questions or comments, drop them below. I'm here. I'm here to answer. Love engaging with the community, and thanks for all that do. And then follow us online. We've got a whole bunch of communities. You can follow us on our social platforms. All the links to those are in the description of this video.